Most investors think that real estate cycles are driven by interest rates. They're not. They're driven by what forces central banks to act. And right now, we're seeing three major forces collide at the same time: an oil shock, a shift towards private credit, and a fragmented housing market across Canada. This is not a normal cycle. And if you don't understand what's happening underneath, you're going to misread where real opportunities are.
I'm seeing more deals fall apart, but I don't necessarily think it's a product of the financing environment. I think it's a product of the fact that buyers seem to have a bit more leverage in this market. It seems that they're able to be a bit more picky. Due diligence phases, like people are really getting to do their due diligence, where 2021, 2022, people were kind of skipping along because the market was so hot and because people had a different level of optimism.
Welcome to Smart Real Estate by LearnInvestManage.com, where we break down real estate through the lens of macroeconomics, capital markets, and real-world investing. I'm Addy Saeed, real estate broker, investor, and advisor. And today I'm joined by Ribhu Rampersad, who brings deep expertise in financing, CMHC structure, and capital strategy. Today's conversation is about something most investors are not fully connecting to yet: how oil shock, credit markets, and housing trends are all feeding into each other, and what that means for investors right now. Before we get into it, if you're actively investing or thinking about entering the market, drop a comment or a message. What's your biggest concern right now? Financing, pricing, or timing? Because this episode is going to challenge how you think about all three. Let's start with the macro, because everything flows from there. Ribhu, I want to start from here, because I think this is the most misunderstood piece right now. There's a lot of noise about oil prices rising over 50% in a short period. But the real insight is that oil shocks don't actually cause recessions. It's the central bank's response that does. What's your read on that?
Yeah, so it's very interesting what's happening right now, and I think completely unexpected, because from an inflation standpoint, I think we're heading in the right direction until everything broke out with the war. But the Strait of Hormuz being the hot topic these days and 20% of oil passing through there, we've all felt it at the pumps already. I think, what was it, like 185?
And it's going up. It's not coming down.
Yeah, I think that's the tip of the iceberg. Predictions for the Fed, for the Bank of Canada and everything, we're predicting that the Fed is going to drop rates, even up to 60 basis points before the end of the year in the US. And that's been completely wiped out now. Bank of Canada is in lockstep with that. I think they were being less aggressive on their projections of rate cuts prior to the war breaking out. But even so, I think we're at a potential risk of rates reversing course with the central bank. On the fixed rate side, we've seen a huge spike in Canada mortgage bond yields over the last 30, 45 days, which has directly impacted commercial rates and residential fixed rates. I think if this is a prolonged conflict, it's a real risk that Bank of Canada and the Fed is going to have to respond to the rest of the mortgage market, which is definitely going to put a spike in things.
Yeah. Well, given the oil prices going up, obviously it's going to add to the inflation number. Yes. And we all know that our Bank of Canada, our central banks, likes to react with broad strokes to curb inflation because it's been moving in the right direction, and this is going to drive it in the other way. So any prediction? What are your thoughts on rate sensitivity in real estate right now? Where do we sit?
So sometimes I say that being a mortgage broker these days is almost like being a day trader. That's how crazy the rate sensitivity has been lately, with huge fluctuations in the mortgage markets right now. It's almost a daily, weekly conversation with clients who have upcoming closings coming up, especially in the CMHC space, about, do we lock in now? We have a crazy buy down. What's the deal? Like, our exit pro forma, we're getting into this construction project, but if the rates stay as it is, my takeout pro forma doesn't pencil anymore. So right now we're in a very volatile time where I think the general consensus is people are trying to still move forward with things. But yeah, rates have been crazy lately for sure.
Yeah, so the real risk right now is not the oil shock itself, even though that's the cause of it. It's the possibility that inflation stays elevated longer than expected. And if you have sticky inflation and it stays longer, obviously any rate cuts that we were expecting, they get delayed, borrowing costs stay elevated, and that actually all feeds into the downward pressure we have in the housing market. And we're going to talk a little bit more about the housing market and what we're seeing in the numbers right now too. But I think this is a perfect illustration of what we're seeing right now. So there's a concept called the efficiency paradox, and it becomes really, really important. Right now, over the past 20, 25 years, we've actually been working towards becoming much more efficient. So our bulbs are all LED. We have government programs through CMHC where we have efficiency incentives available, where you can get longer amortization if you spend money on your buildings and making them more efficient. But we're actually not consuming any less. We're becoming much more efficient, but we're actually consuming the same amount of energy. And this is what is called the efficiency paradox. And so inflation doesn't really disappear the way people expect it. It just basically lingers. Ribhu, what do you think plays into rate expectations? How do you think that plays into the rate expectation over the next 12 to 24 months?
Yeah, so that's interesting because I think as you came out of COVID and all of these things, a lot of people expected inflation to just sink back down, that the rates are going to be a magic solution to everything. And to your point, it's really proven the opposite, that inflation is here to stay. And given the global context and what's happening geopolitically right now, it's going to be really sticky moving forward. We've seen it, we feel it in our restaurant bills, everything. The prices are here to stay. And if we aren't able to curb this, a lot of economists are predicting rate hikes in the next 12 to 24 months as being a real potential. Like there's a real chance of that happening over the next 12 to 24 months with rate hikes coming back, which it's going to be interesting to see how that plays out into the market, because we were getting to a point of a sweet spot of affordability where prices have come down, but rates were down as well. So you're seeing a lot more action into the market. I think going into COVID, Canada was at like all-time highs in household savings, which kind of got depleted. I think it's going to put a real risk to the regular homeowner, home buyer. If rates were to go up, prices kind of stayed where they're at, inflation goes up, so they're unable to replenish some of that savings. And I think just the shift to multifamily real estate and the need for that housing is going to become more and more prevalent.
How do you think the lenders are going to behave, given that we were in a environment where expectations were meeting between buyers and sellers and we were starting to see transactions? Do you think lenders are going to continue acting like they're in recovery, or we're going to see pullback from the lenders?
So I think we've already started to see a pullback from lenders, and not only because of rates. I think what's been driving the pullback even before the conflict broke out was all the reports around rent compression. I think rent compression has become a primary concern, which then directly impacts, especially exit valuations. And as we see a big uptick in construction projects or new construction being sold on the resale market in Alberta, for example, we're seeing a lot of lenders starting to have less appetite for higher leverage deals. If you're low loan to value, strong DCR, strong borrower net worth, they're jumping at it. There's tons of money out there to lend, but what they're lending on is really changing. Especially as you go down the debt cycle, CMHC insured probably being relatively easy to get these days. You're starting to see a lot of the private lending, the mix, and so on and so forth, really, really getting conservative on appraisal valuations. So I don't think that's going to end. I think lenders are going to continue to tighten up. I think the last 45 days since the conflict broke out, rates kind of reversed, really put things into shock, where people were a bit on the fence with rent compressions, and this kind of pushed them over one way.
So from what I'm understanding, there's definitely conservative underwriting. If you're a buyer in today's market, make sure you conservatively underwrite. What does that mean? Make sure that you are really looking at your market rents, looking at your current rents. Your gap to market may not be as big as you think it is. Obviously, future rent growth or limited rent growth in the future means that there's going to be limited growth in the valuation of the property. You have to review the debt coverage ratios that you have on going into any deal. What kind of spreads are you seeing right now with lenders when they're looking at CMHC loans and maybe conventional loans?
Yeah, so I mean, it really varies. So general rule of thumb, as the bigger the loan, the cheaper it is the general rule of thumb. I haven't seen much change to spreads since everything has kind of broken out. It's just when your 0 point is a lot higher, about 40 basis points higher on the 5-year CMB since the end of February. That's really affecting rate. So talking generically on a $2 to $3 million loan size, we were closing these at between 3.9% and 4% with the spread applied back in February. And now we're in the low fours, so 4.2 to 4.3 in some cases. We haven't seen much changes to spread since everything's changed, but the starting point is definitely a lot higher. I think lenders, especially on the CMHC front, I think they want to get deals done. They really want to. It's just the market's making it very hard.
So what kind of gap are we seeing between CMHC and conventional right now? Has that been changing over the past little bit?
I'd say I'm seeing a lot of change in the consumer behavior between CMHC and conventional. We're starting to see an uptick in more borrowers kind of going back to conventional, especially if they don't need higher leverage. Especially since MLI Select changed their premiums for MLI Select. I think a lot of people are starting to look at the total APR, total cost of borrowing. And unless they need that high leverage, we're seeing a lot more people switching back to conventional debt, which is interesting. I'd say conventional term debt is also priced very well right now. We're seeing low fours for conventional term debt, especially in the multifamily space. So it becomes a conversation now, especially since the CMB bumped. Rate is not that different. If they don't need the maximum leverage, yeah, we're seeing a lot of people moving back to conventional debt, which is interesting.
Are you seeing any deals fall apart at the financing stage today? Let's say compared to like 2021, 2022?
I'd say, yeah, I'm seeing more deals fall apart, but I don't necessarily think it's a product of the financing environment. I think it's a product of the fact that buyers seem to have a bit more leverage in this market. So it seems that they're able to be a bit more picky. So due diligence phases, like people are really getting to do their due diligence, where 2021, 2022, I think people were kind of skipping along because the market was so hot. and because people had a different level of optimism. So yes, I'm seeing things falling apart, but I think it's because people are being more picky in what they move forward with.
So not so much that deals are not penciling. It's basically buyers are looking at it going, yeah, I really, really like this property. And like, it doesn't check all of the boxes. So I'm going to walk away from it versus it checks all the boxes.
Yeah.
Any appraisal gaps? Anything that you've seen for appraisal gaps?
Yeah, we're definitely seeing appraisal gaps, especially in the B and private markets. I think CMHC's benchmarks are pretty clear. If you have an appraiser who knows what they're doing from a CMHC standpoint using expense benchmarks, we're pretty on point. But we are seeing some sort of appraisal gaps, especially when it comes to cap rates. I think cap rates have moved quite a bit the last 12 to 18 months. Not everybody has necessarily adjusted for it. I'd say a big difference over a year ago, lenders may not have pushed back as much as they are now. But both lenders and CMHC are pushing back on cap rates that they don't think are realistic, and quite aggressively so in some cases.
Sorry, can we dig into this? So you have lenders that are questioning the appraisal that they got?
Yes. Yeah.
That's actually very interesting. Tell me more.
Yeah, I think especially in the high leverage space right now, lenders, I think we're starting to see a little bit of cracks in the market, especially for certain lenders who've gotten a bit more aggressive in their growth phases. So we're seeing a lot of situations where lenders, when they're seeing a lot of volume, they are questioning, diving deep into dollar per square foot for commercial rents, digging into cap rate assumptions, digging into dollar per unit assumptions. I've seen lenders push back quite a bit now. It's important to work with appraisers who know where the market has shifted. It seems to be moving month by month. And CMHC as well has been pushing back on appraisals that they believe the valuations are too generous. So it's really important right now to be very key. I would say even mixed, like in the private space, they're even more aggressive in challenging appraisals. And I think because they have likely seen the higher proportion of defaults in the current market, I feel like in those cases, appraisals are more of a compliance checklist for them because I feel like they're doing their full underwriting themselves in today's market.
That's interesting. So what we're really saying is that the market is no longer deal driven. It's financing driven. And your lender is playing a very big role in actually helping you complete your due diligence on your assets too. And they're actually questioning the valuation that you're offering. Well, this ties in really well with what we're seeing institutionally. Blackstone just raised over $10 billion in an opportunistic credit, and it actually was oversubscribed. And that's not random. Ribhu, what does it signal to you when institutions move heavily into credit instead of equity? What are your thoughts on that?
Yeah, so definitely it's very, very interesting. And I think it's a result of an emerging gap in the market where you're seeing a lot of the bigger banks really reduce their risk appetite for various asset classes, working on especially non-multifamily asset classes. For example, I'm working on one file right now. It's a client who owns a bunch of trucking yards who had debt with a big five lender, good standing, but now they're just reducing their transportation exposure because they believe with tariffs and everything, the market's going the opposite way. So these guys, it's a prime example of a client who has to now pivot to institutional private credit because they're operating a business. They can't just sell. But an asset like that, I think is a great opportunity for that private credit. I think there's an emerging gap where these institutional private credit funds are going to be a great fit and generate a very large yield with, I'd say, arguably very minimal operation versus what an equity operation would look like.
Yeah, so what we're seeing is basically a lending opportunity being created, and the risk-adjusted returns are actually pretty nice. And they're filling the bank gap that is being created because we all know that developments are showing up in the market, and most of the time they're being pushed there because of power of sale. And this is a gap that is being created, but there's not a lot of lenders out there for that kind of product. And that's the gap that private credit fills in, given that the fund that you're dealing with has the appetite for that.
Yeah.
So does that mean we're entering a phase where the best opportunities are not buying assets, but actually financing them?
Yeah, so I think that really depends on everybody's individual risk profile. I personally, as anecdotally as an investor myself, I believe having good knowledge of these financing strategies as a tool to build out long-term equity is great. That being said, I feel like if you're raising funds or holding yourself accountable to external partners, it's a lot more difficult to predict an equity criterion without extensive experience. I think it just really depends. I think there's huge market for private credit right now. I also think it's a great opportunity for equity, but on the equity side, I think it's going to be extra important to have a depth of experience or ensure you're acting for yourself.
Yeah. So instead of saying, what should I buy? Instead, investors should be asking, where is capital needed most? And hopefully the return that you generate is going to be a lot better than what you're getting or you're going to get. Let's zoom into Canada because the housing market is doing something very unusual right now. It's not moving in one direction. It's fragmenting. So here's the breakdown. Toronto is actually starting to stabilize. Montreal is still rising. Vancouver still declining. Calgary is in a balancing phase. Ribhu? From a financing perspective, how do lenders interpret a market like this? Do they price risk nationally or market by market?
Yeah, so that's an interesting question because I think that answer has changed in the last 6 to 9 months, where we're seeing lenders price risk a lot more market by market, not only from a interest rate pricing standpoint, but from an appetite standpoint. Just this morning, I had a conversation with a large credit union in Alberta who typically would fund a lot of these pre-construction multifamily deals turnkey. And because, I guess to your point, the Calgary market's sort of balancing, probably declining in some areas, they've actually decided to put a pause on any loans that are not for existing members under $5 million, whereas they were very prevalent in that operating space. I had another conversation later in the morning with a big five lender who has completely also paused lending in the sub 5 million space in Alberta as well. So you're seeing lenders sort of change where not only their pricing, but also their risk appetite. And you're seeing a lot of lenders starting to have less appetite for the sub $5 million loans as they believe the market becomes too leveraged.
That's interesting. So sub 5 million means all of these ads that I see on Facebook and TikTok for all these like MLI select and 5% down. That's the market that they're trying to basically reel in right now.
Slowly, yes. And I think what we're going to see is as some of these players get out of the market, naturally supply and demand, you're going to start to see pricing increase for those types of deals. Because there's still going to be lenders who are going to do it. There always will be.
Yeah.
But if they know that they're only game in town, you can see pricing go up. Versus a market like Toronto, I would say lenders are still very bullish in Toronto, GTA. They're probably being a little bit more conservative and underwriting from a rent standpoint. But from a spread, from a pricing standpoint and appetite, it's still very much there.
So I guess let's focus in on Toronto and the real estate market. What we're seeing in Toronto right now is sales are increasing, listings are declining, but prices are still falling in Toronto. Is that the early stages of a bottom or just a pause before we go into a further correction? What are your thoughts? Is it stabilization or recovery?
In my opinion, I think it's really asset class driven.
Well, we focus on multifamily. We'll try to keep the
Yeah.
numbers and keep the focus to multifamily, but we do dip into other asset classes. We try to look at real estate
Yeah.
as a whole. And part of the reason I like to look at it that way is because there's a lot of capital that is tied up in all these condo sales. And eventually that money would have made to other investment opportunities, much like multifamily.
Yeah.
Because I truly think that a lot of these investors, once they exit, once they have 3, 4, 5 properties, they really need to look at multifamily as their next phase in their investment life evolution. So that's my little take on it. But I would love to hear what your thoughts are. Do you think we're going into a stabilization or going into recovery? Let's keep it broad all over real estate then.
Got you. Yeah, so I'll put the caveat because you mentioned condos. I don't think we're at the bottom yet for condos, but everything else. So for the multifamily focus, I believe we're at the early stage of stabilization. When you're starting to see things actually trade on the market in Toronto for almost like a 5 cap plus, I think that's a sign of things starting to stabilize a bit. I feel like there is a lot of opportunity that already exists in the market. I can't really see prices going much lower in the multifamily space, as I feel like there's been a lot of pain. Like I feel a lot of the power sales are already on the market. They've flowed through the market. And I think the comps are suggesting that already. Yeah, appraisals have been tough. Let's put it that way.
Yeah, no, we're definitely seeing a lot of cap rate decompression. There's no doubt about it. The prices have come down significantly. Just in the past week, I have seen a 10-unit building in Mississauga for $180,000 a door.
Well,
I have seen an 18-unit building in Hamilton for $155,000 a door.
well,
I've seen another one for $180,000 a door. Like we have seen some great prices coming out of this market right now. And I think all of it is being driven by the power of sale listings.
Yeah.
And what we're seeing right now, as you can see from the number of new listings dropping, is indicating to me that sellers that are looking at the transactions being posted and saying, you know, that's not a price that I'm willing to sell at, they're actually taking their properties off the market or they're expiring and they're just not renewing. Versus people that are actually staying in the market are people that need to sell and they're adjusting their expectation. So you're still seeing prices being declining. So that's my little caveat. That's what I take from it.
Fair.
And listeners, if you're finding this valuable, follow the show, leave a comment. We'll continue breaking down these macro and real estate connections with real world investor strategies. Let's talk about what this actually means on the ground, because this is where things get interesting. Ribhu, where are you starting to see stress build up right now?
So it's been building for a little while, and we're really seeing things come to fruition from a stretch standpoint. Is a lot of buyers who got in the market a couple of years ago with aggressive value add projects. You're at this spot of rising interest rates because the conflict is going on right now. So declining rents and decompressing cap rates. So they're kind of caught in a perfect storm of not being able to execute their initial business plan. Now, there are some experienced operators who are still able to execute and or have sufficient equity in order to hold on. But where we're seeing the stress is for people who've over-leveraged. A lot of the smaller operators who've taken on promissory notes, high expensive bridge debt. We're really seeing that right now in the market. You kind of alluded to it earlier on, the power of sales that are shifting through the market. I feel that that is primarily those operators who just could not execute on that. I think a risk that we'll see coming up is on a lot of these construction projects with aggressive pro formas when it comes time to take out financing. But yeah, it's going to be interesting to see how that flows through the pipeline of the market in the next 12 to 18 months.
Yeah, you're right, because we already know that the vacancy rate for new builds, especially in Toronto, is currently sitting over 7%. And partially, one of the main reasons it's sitting that high is because the affordability gap is so high, and the builder slash owner slash operator cannot afford to discount their rent because their exit valuations will be upside down.
Yeah.
So what you're seeing in the marketplace is a lot of incentives. You're seeing a lot of discounted rents that are being offered to any new prospective tenant that is looking to move in right away. So if you are a tenant that is looking for a property to rent right now in Toronto and you're looking for something newer, you have options available where you can get half a month, 1 month, sometimes even 2 months of free rent over the course of 1 to 2 year lease, which is substantial. That means if you get 1 month of free rent, that means you're getting an 8% discount off your total rent. And that is quiet distress that is just completely building up right now.
Yeah.
So aside from the power of sales that we're seeing, aside from these glaring signs that we're seeing about vacancies, are you seeing distress publicly, or is it mostly happening behind the scenes right now?
I think it's a bit of both. I think if you're in the right networks, you're seeing the distress quietly. I mean, the nature of power of sales is they need to go to markets in order to sell. But you are seeing a lot of people trying to offload prior to it getting to that point. That is the owners themselves trying to dispose of things. There is quite a bit happening behind the scenes for sure. But I think it's tough because I think buyers know that they have the power right now. So unless the seller is willing to really take the hit or come to reality, I don't know how much of them are actually being successful until it hits the market and it's too late.
So we're not in a crisis, but we're in a pressure building phase right now. So what does an investor do right now? Wait or position?
So I think the time for waiting has passed. I think investors with capital are deploying right now, especially for investors who have a mid to long-term time horizon that they're willing to invest for. I think it's interesting because in Ontario, you can buy buildings with CMHC on the acquisition, which is not something you could have even considered in years past. But it kind of shows the cap rate to interest rate balance that we're sitting in right now. I think the time has probably passed for super aggressive value add with 100% equity pull out at the end, at least for the average person. But for investors with capital, I think it's a great opportunity right now. And I think the opportunity to take advantage now is you're going to look at it in 10 years from now and be happy that you did it. Like, I think we're in the dip and it may take some time to reverse course, but in long-term time horizon, I think people are going to regret missing out on this opportunity.
You know what? There's so many times that I have reviewed some deal and I will go back to it after like 7-10 years. And I'm like, I did not buy that one, or I should have bought that one. I got stubborn and I didn't spend the extra $100,000 and bought it. Look at the return that it generated. So from what I'm understanding, you're saying is that prepare your capital, make sure you have your capital, and build your lender relationships. Reach out to Ribhu, have a conversation with him, and then understand the structure that you're going to be going in on. And then get ready, go out there, look at properties and see if there's one that matches what you're looking to do. So if you take one thing from this episode, is this cycle is not about timing the market. It's about understanding how macro drives rates, how rates drive financing, and how financing drives deals. If you're navigating a deal right now and trying to understand how to position yourself, drop a question in the comments. We'll either respond directly or turn it into a future episode. For deeper breakdowns, resources, and tools, visit learninvestmanage.com. By the way, we're building a community of investors focused on clarity, structure, and long-term thinking. Join the conversation and keep learning with us. Again, the goal of our show is to help investors learn, invest, and manage with clarity and confidence. Addy Saeed is a licensed real estate broker with Remax Gold Realty and a member in good standing with Canadian Real Estate Association, Ontario Real Estate Association, and Toronto Real Estate Board, and the Real Estate Council of Ontario, license number 47353346. I'm also a licensed dealer rep with Westcliff Corporate Finance, a division of Waverley Corporate Financial Services Limited, an exempt market dealer registered and licensed in Ontario. Ribhu Rampersad is a mortgage level 2, licensed under DLC National F FISRA license 12360, mortgage license number M22003805. This podcast is for informational and educational purposes only. Nothing discussed should be considered financial, legal, tax, or investment advice. Real estate investments involve risk, and past performance are not indicative of future results. Always consult a qualified professional before making any investment decisions. Any examples discussed are for illustrative purposes only. Thank you, everybody, and we will see you in the next episode. Thanks, Ribhu.
Thanks.